Hello students, welcome to the third unit of our course Mutual Funds. So this is the first lecture on mutual funds. So let's begin our first lecture on mutual funds. So nowadays we are looking at so many ads about mutual funds in television. So just wait, let me adjust my screen. Okay, so let's begin. So these are the ads we are normally watching on television, almost all television channels. So mutual funds sahi hai, and we can see few famous faces: Mahendra Singh Dhoni, Sachin Tendulkar, who are promoting mutual funds and spreading awareness about the mutual funds, so that the common people will come forward and invest in mutual funds. So after watching these advertisements, सबके लिए mutual funds सही है, mutual funds सही है, but before that we should know what do we mean by mutual funds. So let's understand what do we mean by mutual fund. So nowadays almost every nationalized bank and financial institutions provides facility to invest in mutual funds. For example, State Bank of India, they have their own unit who manage the investment in mutual fund. HDFC Bank, IDBI Bank, etc., and some private financial institutions also, such as Motilal Oswal, Aditya Birla has its own unit for investment in mutual funds. Reliance, Franklin, and many more. So there are so many mutual funds right now in market to invest. Suppose, so why should one invest in mutual fund? Suppose you are from those people who does not have the complete knowledge and confidence to invest in stock exchange, share market, or equity market, and you want your money to grow with time. So then what you will do? Or suppose you are from them who doesn't have the time to do the research work and how and where to invest the money, then what you will do? If suppose you are from them who do not want to take any high risk or on their money and wants a handsome or more than bank returns on or high returns, then what you will do? For people like you, mutual funds sahi hai. So these 3 points, yes, so 3 points, I think it's sufficient for those people who wants to invest in mutual fund. So directly or indirectly, you can invest in share market without having any knowledge or no research, or if you don't want to take risk, you can invest in mutual funds. So here's a definition on mutual fund. A mutual fund is a trust that pools together the money of a number of investors who have common financial goal. The money collected is then invested by the professional in capital market instruments such as shares, debentures, bonds, and other securities. Here, the professional person or persons is called fund manager. So here's a diagram explaining how one is investing in mutual fund. So these are the common people who has no knowledge of share market or don't know how to do research on share market because of lack of time, and they don't want to take risk. So investors, so they are called investors. So investing in bank, so these people, they invest in bank or some financial institute. So bank, so normally bank, they have asset management unit, AMU, which is controlled by fund managers. So every bank or the financial institute, they have their own AMU, and they have their fund managers which look after the AMU. So fund manager invests the money in different sectors. So that fund manager is the person who collects money from these people, and they have complete knowledge of share market, where to invest. So the fund managers invest the money collected from the investors in different sectors. What are those sectors? In share market, bonds, money market instruments, real estate, debt bonds, etc. Okay, so after investing, that fund manager, after getting profit, fund manager deducts his commission or brokerage. He distributes the profit accordingly to the investors. So these investors, they had become some kind of owners to that AMU, and the number of units they had bought, according to that, the fund manager is going to give the profit. So here I have one more definition. A mutual fund is a type of financial instrument in which large number of investors invest their money, and the money collected is operated by fund manager by investing it in securities like stocks, bonds, money market instruments, and other assets. So when we invest our money in some mutual fund or of banks or companies, they allot us unit in return of our money. So they allot us units of their money. So these units are similar to shares of the company. In case of units in mutual funds, we can purchase fractional units. So this point says that you can purchase units in decimal numbers also. So suppose you want to buy 2.5 units of some mutual fund. But in case of shares, you cannot buy 2.5 shares. Shares is a purely integer value. So you can buy 10 shares, 12 shares, 2 shares, or 100 shares, but you cannot buy a uh, fractional number of shares. But in case of mutual funds, you are allowed to buy fractional number of units. Okay, so for instance, if one unit of some mutual fund is for rupees 100 at present, so our rupees 100 paid to that company is invested in many different securities. So my 100 rupees, I have just invested my 100 rupees in a mutual fund, but my 100 rupees is going in different sectors like government bonds, debt bonds, different shares, even real estates, petroleum sectors, golds, and many more, instead of just one holding. Because of dependency of different securities, the present value of one unit keeps on changing every day. So I think this is statement is sufficient to clarify why my price of one unit is changing every day in mutual funds. because of dependency in different securities. So the present value or the price of one unit of mutual fund is called net asset value. So this net asset value is it keeps on changing every day. In fact, I must say that it keeps on changing every minute if it is depending on share market, and it is denoted by NAV. Now, how to calculate? So I think the net asset value is clear to everyone. Net asset value is the market value or the cost of one unit at present, and it keeps on changing. So net asset value of fund is calculated by this formula. So net asset value is equal to total value of the securities divided by total number of units outstanding. So total number of units outstanding means units purchased by the investors, institutional investors, and company officers or insiders. So those many. So how many units are sold out? So they can be purchased by investors, some institutions, company officers, and they are called insiders also. So and the total value of security, total value of security means the total value of assets minus total value of its liabilities. So you just have to remove the liabilities from the total value of asset. That is the net value of the security. So you have to remove the liabilities. That gives you the net net value of the securities or the total value. So here I have some examples of mutual funds and their net asset value. So allow me to zoom in. Okay, so just look at these three mutual funds. One is Nippon India Pharma and Fund Direct Growth. So we will come to this point. What do you mean by direct growth? And this is the net asset value. So one unit of Nippon India Pharma will cost you 224.87 rupees on this date, 31st July 2020. We have one more, Franklin India. Again, it's direct growth. So this is the cost of one unit, that is net asset value on the same date. And again, we have Access Blue Chip Fund Direct Growth. One unit will cost you 33 rupees and 4 paisa. Now let's move forward. So let's see the advantages of investing in mutual funds. So first point is diversification. You can invest your small amount in expensive companies mutual fund, and your money is invested in many different industries. Also it reduces the risk buying also it reduces the risk. Buying mutual fund can achieve diversification cheaper and faster than buying individual securities. So one thing is clear, that you can invest your very small amount in different mutual funds, different sectors. Easy access. Second point is easy access. Easy access, that is high liquidity. We can easily buy and sell mutual funds on our laptop and cell phones. So nowadays we have so many apps on Play Store which shows all the details of mutual funds and how to buy, how to sell within a minute. So there is no locking period. we can buy or sell the units according to our need. We can buy or sell the units according to our need. So third advantage of investing in mutual fund is professional management. So you are not managing your money in mutual funds. There are professionals who are sitting there which look after your money. So primary advantage of mutual fund is that you do not have to worry about in which securities, bonds, shares, or any money instruments you have to invest. If you do not have complete knowledge of money investment, do not worry, fund managers will do this work for you. A mutual fund is relatively inexpensive way for a small investor to get full-time manager to make and monitor investment. And the fourth advantage to invest in mutual fund is freedom of choice. Investors have the freedom to research and select from the fund managers which with variety of styles and management goals. For instance, a fund manager may focus on trading in stocks, value investment, or in growth investment, or in developed markets or emerging markets, income or macroeconomics, etc. So we have different varieties of fund managers who are specialized in different sectors. So if you choose from the fund managers, you can invest in these sectors according to your selection of fund manager. So in this, investors gain exposure to not only stocks and bonds but also commodities, foreign assets, and real estates too. So here I have some pros and cons. So pros about mutual fund is liquidity, tax benefit. So yeah, okay, you can also have benefit in your tax. You can save your money from tax. Some mutual funds are beneficial in which comes under 80cc, so you can save your tax by showing the investment to your CA. Second, diversification, we have seen this. Minimal investment requirements, so you can invest very low amount. Professional management, variety of offering. Cons, so there are fees. You have to pay fees or commissions and other expenses. uh, and one more cons is the large fund size in portfolios. So what do you mean by large fund size? Large fund size means if suppose fund manager is collecting a huge money from the investors, so it becomes that collected money is called fund size. If that fund size is very huge, so it becomes very difficult to fund manager to handle it in some cases. So it comes in cons. So difficulty in comparing funds. There are so many mutual funds available, so obviously it becomes difficult for an investor to compare. So lack of transparency in holdings also. So we actually we while investing, we don't look into the holdings of some mutual funds. We should look into the holdings where that mutual fund is investing our money. Nowadays mutual funds, they are showing their holdings. Now let's talk about types of mutual funds. So here we have types of mutual funds depending on the different classes. So based on asset class, so we have equity fund, debt funds, and hybrid funds. Based on structure, open-ended funds, closed-ended funds, interval funds. Based on goals, growth funds, income funds, liquid funds, tax saving funds, marriage funds, child education funds. There are so many. So I've just listed very few or the famous mutual funds which you can see on any website or app based on risk, low risk, medium risk, and high risk. Now let's see about what do we mean by all these type of mutual funds. So equity funds, so these funds primarily invest in stocks, that is share market, hence also known as stock funds. That funds, these funds invest primarily in fixed income securities such as bonds, maturity plans, monthly income plans, gilt funds, that is central and state government securities, long term bonds, and many more. So that is the debt funds. Hybrid fund. Hybrid fund, as name suggests, it is the mix of stock funds and bonds. Equity fund plus debt funds, suitable for those investors looking to take more risk than debt funds. Open-ended funds, these funds do not have any particular constraints such as time period or number of units which can be traded. We can trade funds at our convenience and exit whenever required at the current net asset value NAV. Closed ended funds. So these funds in these funds the capital to be invested has limits. So we have minimum and maximum amount in such kind of funds. Some funds in this category comes with deadline for buying. So these are predefined. So there is predefined maturity tenure. Next we have interval funds. So these funds have traits of both open-ended and closed-ended funds. So these funds are open for purchase and redemption only during specific intervals. Suitable for investors looking to save a lump sum amount. Also, no transaction will be permitted for at least 2 years. So this is called interval funds. Growth funds. So these funds allocate a considerable portion of investment in shares and growth sectors. Suitable for investors, millennials who have surplus of ideal money to be distributed in riskier plans. Liquid funds, sorry, income funds. So these funds belong to the family of debt funds that distribute their money in mixed bonds, certificate of deposits, and securities. Liquid funds, these funds also belongs to debt funds as they are invested in debt funds and money market. It has a maximum sum allowed to invest. Tax saving funds, equity linked saving scheme, ELSS. So these allows you to save on taxes. These funds are best suited for salaried person. Low risk funds, in case of rupee depreciation, investors are unsure about making investment. In such cases, fund managers recommend putting money in low risk funds. Returns could be 6 to 8%. That is equal to a fixed deposit. Medium risk funds. Risk factor is of medium level as the fund manager invests a portion in debt and rest in equity fund, that is share market. So average rate of return is I think 9 to 12, sometime it increases to 13, 14, because maximum of amount is invested in equity funds. High risk funds, majority of the money is invested in stocks, share market. Suitable for investors aiming for huge returns. Maximum money is invested and the rate of return is around 20%. So I think this is for first lecture of mutual funds. So in this we have seen types of Mutual fund, what do we mean by mutual fund, pros and cons, and we have to see what I have I have marked this direct growth. So direct growth means you are not uh, directly, you are doing all the research by yourself about mutual fund and investing your money directly into that mutual fund through some website or some application available on Play Store. So that is direct investment. That's why direct growth. If you hire some agent, it's not a direct growth to handle your money. So there is a person who is looking after your money to invest in mutual fund. So that is a regular type of mutual fund. So regular growth. So in next lecture we will see if the further topics regarding the mutual funds. So let's stop here. Thank you very much.